and welcome to Chapter 15, Appreciation and Depreciation of the Modern Business book series from the Alexander Hamilton Institute, copyright 1936. And we are well into the technical part of the text. We're looking at special questions that accountants face, and this week's topic is about appreciation and depreciation. So if you are aware of depreciation as a concept, depreciation is basically the opposite. So depreciation, the value of an asset declines over its life. Appreciation, the value of an asset increases over its life. So what might appreciate? Well, land value appreciates, classic cars appreciate, as I well know, and potentially like intellectual property can appreciate. So if you have something patented that takes off, you may suggest that that patent is worth more than it was when you first invented it and nobody knew about your invention. So the statement has been made repeatedly that it is the purpose of the balance sheet to show the true financial position of an enterprise. However, many factors intervene to cause the true values to fluctuate above or below the values carried on the books. No attempt is made to record some of these fluctuations in the books, either because they are only temporary or because they are changes which cannot be measured by the accounting records. As a result, balance sheet figures do not always show true values. And one of the important things we do in accounting is to make sure that if we are going to remeasure the value of an asset, we have to have something reliable on which to base that. It can't just be, well, now I think the patent is worth more because more people know about it. There has to be a reliable source on which we can measure and we can rely. An attempt is made in accounting, however, to measure many of these fluctuations and to express their results in the records. In view of the common acceptance of conservatism as a prerequisite to successful accounting, it becomes decidedly more important to show in the records the effects of the changes which have reduced the value of assets than to show changes which may have increased values. So conservatism is about presenting not the best picture, so we're not the singing happy optimistic people accountants. They are conservative, almost pessimistic, but not quite. It is about trying to achieve realism without overstating anything. So an increase in the value of a building, for example, should never be expressed on the books as part of the regular accounting procedure. It is the land value only, if at all, that will increase in value, as the building must eventually become out of date and decline in value. On the other hand, if a building is used for manufacturing purposes, has decreased in value by virtue of the wear and tear in use, as it surely must, then this decrease in value becomes part of the cost of operating the business during the period, a cost which should be charged to operating expense. So that's depreciation as we know it. So it will be recalled that in the profit and loss statement, the excess of income over expenses for a period constituted the increase in capital for the period. In the balance sheet, it was shown that capital was the net excess of assets over liabilities. Therefore, if there have been no additional investments or withdrawals of proprietor's capital during a certain period of time, then the profit for that period can be obtained by subtracting the capital at the beginning of the period from the capital at the end of the period. So it's just saying that the way we measure what an owner's portion of the business is by the difference between assets, so what the company owns, and liabilities, what the company owes, is the proprietor's interest. So if you are recording profit accurately, the difference between two amounts of capital are profit. Then we go into, but if this increase has been allocated to an appreciation, so the increase in value of an asset, it's much more difficult to ascertain what's actually happening in the business. But because they do occur, it is important to record these changes, because otherwise we're going to be understating the value of a business. So we're going to look at then the measuring changes in value. So the changes in value that are to be measured are those that are permanent in nature. So if there's a peak in the property market and the land value of something increases, but it's going to go basically straight back down again because a new land release is coming, then we're not going to record that because it's a temporary fluctuation. The most obvious method of measurement is to take a complete inventory through a regular periodic revaluation of assets. However, there are some objections to such a procedure, the main ones being, first, the impracticality of obtaining uniformly accurate revaluations. So to be constantly reevaluating something accurately is really difficult. The time required to make such reevaluations is the change, a material change. If the value of a piece of land has gone from $200,000 to $201,000, is it worth the time of remeasuring that because it's an immaterial difference? The cost, both in time and service, in obtaining valuers who are capable, and then the fact that it would be unwise to burden the income or expenses of any one period with temporary fluctuations in market value, which might later be offset entirely through fluctuations of an opposite nature. So we only tend to look for permanent, significant changes that are worth having the revaluations completed. So this last point is worthy of further elaboration. When capital is invested in a business, the investor expects a return in the form of income from this investment and measures the value of her investment by the return which it brings to her. It is immaterial whether investments are made by original contributions or from an accumulation of profit which the proprietor does not withdraw. This capital fund is invested in various assets that are essential to the conduct of the business. So we're just starting to say that really the owner doesn't mind where the profit comes from. Does the profit come from operating expenses? Does the profit come from appreciation of assets? But it's important to understand where the profit is coming from so that you can see if your assets are being put into use accurately or if just capital growth is causing those assets to increase and creating profit. So we then start to think about, well, if we have assets increasing, we'll probably also have assets decreasing. So as we discussed in chapter 14, in the previous chapter, depreciation was defined and a discussion was given of the factors of measurement and causes of depreciation, together with a brief summary of various depreciation methods. With an understanding of what depreciation is and of its cause, let us consider other points of importance. So as if the depreciation chapter wasn't long enough, every businesswoman must realize that since depreciation reduces the value of her asset, it must be provided for in her balance sheet, or public opinion concerning the conservatism of the value stated there will be unfavourable. So presuming that the public have access to your records, you can't just go around overstating everything. More important is the fact that depreciation has a direct effect upon the profits of a business. In fact, depreciation is a part of the cost of doing business and as such should be charged in with the other operating expenses. But then it goes to more detail. So there's another phase of depreciation that often receives insufficient attention. As equipment wears out, some provision for replacing it must be made, and this is something that still happens today. A concern will often fail unintentionally to accumulate funds as rapidly as they are needed for replacement of worn-out equipment unless some special measures are provided to compel the withholding of funds for that purpose. So it's all fine and well to be claiming this depreciation expense in terms of tax and reduction of profits, but are you actually saving up to replace that equipment? The importance of regularly providing for depreciation cannot be emphasized too strongly. Organizations will frequently be found where depreciation has been ignored for years. So replacement of equipment is something that occurs in pretty much every business that needs equipment, whether that's computers, office furniture, or actual tools to produce products. So saving for replacement of that should be part of your business cash flow and part of your business strategy. Now, it's not about tax, it's not about profit and income, it's actually about cash flow. And this really is the first time the book started to dig into cash flow. And then depreciation of fixed asset is an expense of doing business. It is a deduction from the gross income derived from the sales of the company's product or service. Appreciation, on the other hand, is an increase in capital entirely apart from business operations. So it does suggest that sometimes people think that appreciation and depreciation are two opposites of the same coin, but they're really not. They're two quite distinct things. Although they're opposites, they're actually concerned with different things. So if appreciation were used to offset depreciation charges, expenses would be understated and net profits from operations would correspondingly be overstated. One of the chief purposes of accounting statements is to show the true sources of income and causes of expense, and this cannot be done if such unlike items as appreciation and depreciation are offset against each other. So you can't just say, well, I have a building on a piece of land, the land's going up, the building's going down, so together they're worth the same. No, it is important to have those things separately because the building is an operating expense, whereas the land is a capital investment. And then we get on to, well, what can we appreciate and depreciate? So the term appreciation and depreciation, as a rule, and the principle more than just the term, do not apply to changes in the value of current assets. So we're only talking about non-current assets or fixed assets. This is due to the character of the items that comprise the current asset classification. Raw materials and finished goods, in which the greater part of the working capital is invested, are kept in stock for relatively brief periods of time. Furthermore, they are consumed or disposed of in single units, where the fixed assets are kept in service over a long period of time. It can hardly be said that these units appreciate or depreciate in the same way as buildings and machinery. So we're talking about stock, inventory, supplies. So maybe you work in gold or silver or precious metals or precious gemstones, and you know that the value of that, value of that supply fluctuates with the market. So you're not going to be reevaluating your stock every time you do that, because otherwise you're going to be at the mercy of the market price when it's not actually the cost you incurred when you purchased it. So the price of current assets do fluctuate. However, even though the specific items do not remain in the possession of the business for any considerable period of time. Then it goes on to suggest that if you were to follow this method of reevaluating your inventory or supplies every time, you're going to see such high fluctuations that you're never going to really understand the profit or expenses of your business. So the rule that has been adopted by most accountants is to value stock on hand at cost unless the current market figures are lower, in which case the market prices are used. But I would suggest that for most small businesses, these fluctuations really will be immaterial, and the time you would spend in recalculating the value of your inventory is going to be significantly greater than the change in your actual assets. But you do have to remember that sometimes you end up with obsolete inventory. So if you were creating beaded jewellery and then you moved into metal jewellery, silversmithing, for example, those beads, although they still have a value, they're really not part of your business anymore, and you should probably remove those from your inventory counts because they're no longer an operating expense. So you would be writing those out of the business because they're no longer of value to the business. Now, yes, if you can sell them, you should sell them, and that should be part of the business proceeds. But if they're just going to sit there and decay, if they're wooden beads and then they start to disintegrate or whatever reason, polymer clay that then sits in its packet open and goes hard and becomes unusable, you have to remember to remove those, and it is a cost of business when you do that because you did purchase the cost and write them up. So we're going to leave the appreciation and depreciation chapter there. If you've enjoyed the video, please comment or like, or feel free obviously to subscribe to the channel to know when the videos come out next week. We are looking next week to chapter 16, Modern Books of Record, which seems like it's going to be quite non-modern. Anyway, I'll see you next week.